Hey, everybody, it's Chris Englebert with Englebert Financial Advisers in Allentown, Pennsylvania, with this week's Englebert Angle. And we're talking about something getting ready for tax season starts in December. Now, before you go crazy and say, I don't want to even think about taxes, I wait until April, you got to do some things to get ready for the tax season. And the more prepared you are, now the easier it becomes as far as tax season goes. So what are some of the things that you can do between now and the end of the year? You can max out your 401k, your 457, or your 403b. Take a look at your last pay stub and see how much money you put into your 401k, 457, or 403b, and check to see if you're on target for where you want to be. Because remember, any monies that you put into those types of accounts are pre-tax, and it's going to allow you to save money when it comes to April 15th. So the other tip that we always give people is if you're going to get an end of the year bonus, talk to your payroll department before you get that bonus paid and say, hey, listen, I'm getting a bonus of X dollars. I want to put half of it in my 401k, 457 or 403b. You got to talk to them before it gets paid to you, because once they pay it, they can't go back and unscramble scrambled eggs. So a good idea is to put an end of the year bonus in. And also the other good idea is check if you're married, how much your spouse is putting into the 401k, 457 or 403b. We are always amazed that we have couples that don't talk to each other, and then when it comes tax time, they're upset because they have to pay a lot to the IRS. And when we look at what they've been contributing to their retirement accounts, they haven't either maxed out or put some additional money in. So check with your spouse, have that conversation, obviously before December 31st, because 401ks, 457s, and 403b accounts are all payroll deduction accounts, and you've only got a couple of pays left, including a bonus, to be able to put more money away for this year. The other thing you can do is if you have a taxable account, you can do tax loss harvesting. So what you do is you look at your realized gains for 2023, then you go through all of your positions and you look at your unrealized losses and say, hey, do I want to sell something to offset some of the gains that I've achieved? And vice versa. If you've sold something for a loss this year, you may have a gain that you want to peel back or pare back a particular position that's got a big gain in it to offset those losses. You should never go into tax season with realized gains and then end up paying taxes on them if you have unrealized losses in your portfolio. We are doing tax loss selling all the time. Now, sometimes we do it at different times during the year. Normally, I try to get my tax loss selling done by October, but we are very positive on the markets in October. So we've been holding off, and there's been a big rally in November so far this year. So we've held off, and we're doing our tax loss selling or harvesting later this year, because we obviously wanted the accounts to go up and have bigger gains, that if we had any losses, we could use them to offset. So tax loss harvesting is a key. Make sure you know in your taxable accounts what your cost basis are. And finally, if you're a seasoned citizen and someone who's taking a required minimum distribution, don't forget, if you haven't taken your RMD this year, your required minimum distribution, whatever portion you give directly to charity is not included as income. So if your required minimum distribution is $10,000 a year and you give $2,000 to your favorite charity, and it's got to be a qualified charity, it can't be a Seinfeld charity, the human fund that George was always talking about, which later turned out not to be a charity. If it's a qualified charity and you give a portion of your RMD to that charity, then rather than the whole RMD showing up as a taxable amount that you got to pay taxes on, only the portion that you did not give to charity. So again, if you have $10,000 in an RMD, you give $2,000 to a charity, $8,000 is going to show up as far as what you pay taxes on. You got to get on this, because rather than writing a check directly to your charity, if you're receiving an RMD, it's the most tax advantaged way to give that money to an organization where you do good and you receive good from it, from the fact that you're not paying taxes on that required minimum distribution. As always, if you have any questions, every investor is different. Contact us for questions you may have for an end of year tax strategy for yourself. We do this all the time. We're talking strategy for our clients. So that's all we have this week. We'll be back soon. Talk to you later.